I used to wake up every morning convinced I was a trader, charts spread across 3 monitors, coffee getting cold as I hunted for the perfect setup. RSI divergence here, support and resistance there. I had it all figured out until the market opened. Then something strange would happen. My carefully crafted plan would evaporate the moment real money was on the line. A perfect breakout would trigger, and I'd hesitate. A clear stop-loss level would get hit, and I'd hold on hoping it would reverse. My emotions weren't just influencing my trades, they were making every single decision for me. Sound familiar? For 3 years, I lived this nightmare. I'd study for hours, practice on simulators, nail every setup in hindsight. But the second I clicked that buy button with actual capital, I transformed into someone else entirely. Someone who second-guessed every move, moved stops further away from price, and somehow always found a reason to break my own rules. I wasn't trading, I was gambling with a really expensive psychology degree. The breaking point came on a Tuesday morning in March. I had what looked like the setup of the century. Clean chart pattern, perfect volume confirmation, every indicator aligned. I sized up bigger than usual because I was so confident. Then I watched in horror as the market gapped down overnight, taking out my stop and half my account with it. But here's the twist. That devastating loss became the most valuable thing that ever happened to my trading. Because it forced me to ask a question I'd been avoiding for years. What if the problem wasn't my strategy? What if it wasn't my risk management or my chart reading skills? What if the problem was me? That question changed everything. Welcome to Trading Psychology Stick, where we dig into the mental game behind consistent profitability. I'm about to share the exact process I used to transform from an emotional wreck who bled money to someone who actually builds and maintains real trading edge. This isn't about meditation or positive thinking. It's about the mathematical and psychological framework that separates professionals from everyone else. But first, let me be crystal clear about something. What I'm sharing comes from years of painful trial and error, studying prop firm methodologies, and finally understanding what actually creates sustainable results. This is educational content, not financial advice. Trading involves serious risk, and most people lose money. Now, if you've ever felt like you're fighting yourself every time you place a trade, if you've ever wondered why your paper trading results never match your live trading, or if you're tired of being your own worst enemy in the markets, then what comes next will fundamentally change how you approach this game. Because I'm going to show you the 3-stage transformation that took me from emotional chaos to systematic clarity. First, how I discovered that everything I thought I knew about trading success was built on quicksand. Second, the mathematical revelation that separated my feelings from my results. And third, the identity shift that turned trading from an emotional battleground into a business process. Let's start with the uncomfortable truth that nobody wants to hear. I thought I was learning to trade, but I was actually learning to lie to myself. Every win felt like validation of my genius. Every loss was just bad luck or market manipulation. I kept a mental highlight reel of my best calls while conveniently forgetting the disasters. My brain was running a propaganda campaign, and I was the only one buying it. The first crack in this delusion came when I tried to explain my strategy to another trader. I started with confidence, talking about support and resistance, momentum indicators, volume analysis. But the more I talked, the more I realized I couldn't actually define what I was doing. My rules were vague, my criteria shifted based on my mood. I had opinions masquerading as methodology. He asked me one simple question that shattered everything. Show me your last 50 trades and walk me through your decision-making process for each one. I couldn't do it. I had maybe 12 trades documented. The rest lived in my memory, distorted by time and emotion. I thought I had a system, but what I really had was a collection of hunches dressed up with technical analysis. This is where most traders get stuck. They mistake activity for progress, they confuse complexity for sophistication. They think more indicators equals more edge, but all they're really doing is adding layers of confusion to an already chaotic process. The market doesn't care about your indicators, it doesn't care about your analysis. The market is a massive auction where millions of participants express their opinions through their actions. And if you can't define your own edge clearly enough to teach it to someone else, you probably don't have one. That realization hit me like a freight train. I'd been playing a game without understanding the rules, competing in an arena where I didn't even know what victory looked like. I was bringing a knife to a gunfight, except the knife was made of my own emotions and the gunfight was happening inside my head. But here's what I learned from that devastating clarity. Confusion is actually a gift, because once you admit you don't know what you're doing, you can finally start learning what actually works. The second stage of my transformation began with a simple but profound shift in perspective. Instead of trying to be right about market direction, I started focusing on being consistent with my process. Instead of predicting what would happen next, I started defining what I would do if specific conditions occurred. This wasn't just a mental exercise. I had to rebuild my entire approach from the ground up, starting with the most basic question. What actually creates an edge in trading? The answer surprised me. It wasn't about finding the perfect entry or predicting market moves. It was about mathematics. Cold, hard, emotionless mathematics. Every successful trading approach boils down to a simple equation. You need your average wins to be large enough and frequent enough to overcome your average losses. But here's where it gets interesting. Most traders focus on being right more often, trying to increase their win rate. They celebrate when they nail 7 out of 10 trades, feeling like they're onto something special. But the math tells a different story. I met a trader who won only 35% of his trades, but made more money than guys with 80% win rates. How? His average winner was 3 times larger than his average loser. He understood that profitability isn't about being right. It's about being right in the right size when you're right, and being wrong in small size when you're wrong. This completely flipped my understanding of what trading success looked like. I'd been optimizing for the wrong variable. I was trying to minimize losses instead of maximizing the mathematical expectation of my approach. I was playing defense when I should have been focused on sustainable offense. The breakthrough came when I started tracking not just my wins and losses, but the actual mathematical expectation of every trade I took. I calculated my real win rate, my actual average win, my true average loss. Then I plugged those numbers into the expectation formula. The result was shocking. Despite having what felt like decent results, my expectation was negative. I was slowly bleeding money even when I thought I was doing well. My memory had been lying to me about my own performance. The wins felt bigger than they were. The losses felt smaller than they actually were. That's when I understood why so many traders quit. They're not failing because they're undisciplined or emotional, though those things don't help. They're failing because they're trying to perfect systems that were mathematically destined to lose money from the beginning. But once you see this truth, everything changes. You stop chasing the perfect setup and start building systematic edge. You stop trying to predict outcomes and start focusing on probabilistic thinking. You realize that trading isn't about being right, it's about being profitable over time. The third stage was the hardest because it required changing not just what I did, but who I was when I did it. I had to separate my identity from my trading results. I had to learn to execute my system regardless of how I felt about individual trades. I had to become someone who could lose money without losing confidence and make money without getting overconfident. This identity work isn't soft psychology, it's the foundation that determines whether your edge actually translates into profits. Because you can have the best system in the world, but if you can't execute it consistently when real money is on the line, you might as well not have a system at all. I started small, really small, position sizes that felt almost embarrassingly tiny. But here's what happened. When the financial pressure was removed, I could finally see my own patterns clearly. I noticed that I traded differently after wins versus losses. I discovered that my decision-making quality deteriorated significantly after 2 consecutive losing trades. I realized that my best executions happened when I was emotionally neutral, neither excited nor fearful. These insights became the foundation for building systems that protected my edge from my psychology. I created rules for when to trade larger, when to trade smaller, and when not to trade at all. I built protocols for managing my emotional state before, during, and after trades. The transformation wasn't instant. It took months of deliberate practice to rewire my responses to market volatility. But gradually, something shifted. Trading stopped feeling like an emotional roller coaster and started feeling like work, productive, systematic work that generated consistent results. The real test came 6 months later when I faced another significant drawdown. But this time was different. Instead of panic or self-doubt, I felt curiosity. Instead of questioning my approach, I reviewed my data. The numbers showed that my system was performing within expected parameters. The drawdown was normal variance, not system failure. That's when I knew the transformation was complete. I wasn't trading my emotions anymore. I was trading my edge. But building real edge is just the beginning. In the next part, I'll show you the exact framework I use to identify, test, and implement systematic approaches that actually work in live markets. You'll discover why your current strategy might be sabotaging your results, and how to build something that compounds your success over time instead of fighting against your natural psychology. The framework I'm about to share didn't come from a book or a course. It came from dissecting my own failures until I found the patterns that actually mattered. Because once I stopped trading my emotions, I realized I had nothing left to trade. My entire approach had been built on feelings disguised as analysis. So I had to start over. But this time, I approached it like an engineer instead of a gambler. The first component was brutal honesty about what I actually knew versus what I thought I knew. I took every trade I'd made over the previous 6 months and categorized them. Not by profit and loss, that was just noise. I categorized them by the quality of my reasoning at the time I took the trade. Category 1, trades where I had clear, predefined criteria that I could explain to someone else. Category 2, trades where I had a general idea but was making it up as I went along. Category 3, trades where I was purely reacting to price movement or my emotions about missing previous moves. The results were humiliating. Less than 20% of my trades fell into Category 1. The vast majority were Category 2 and 3, impulse decisions dressed up with post-hoc technical analysis. I was basically throwing darts at a board and then drawing circles around wherever they landed. But this brutal audit became the foundation for everything that followed. Because you can't fix what you won't acknowledge. And I had to acknowledge that most of my trading decisions were emotional reactions, not systematic responses to market conditions. The second component was understanding the difference between patterns and randomness. This sounds simple, but it's where 90% of traders get lost. They see a few winning trades using some combination of indicators and convince themselves they've discovered something meaningful. But the human brain is a pattern recognition machine that sees patterns even in pure noise. I started testing this systematically. I took every setup I thought was profitable and ran it through historical data, not cherry-picked examples, every occurrence over multiple years across different market conditions. The results were sobering. Most of my favorite setups had win rates that were barely better than coin flips, and the ones that did show promise only worked in specific market environments. This is where most traders give up. They realize their favorite strategies don't work as advertised, so they go hunting for new ones. But I took a different approach. Instead of looking for perfect setups, I started looking for imperfect setups that I could execute consistently. The breakthrough came when I stopped trying to predict what the market would do and started defining what I would do in response to what the market actually did. This shift from prediction to reaction changed everything. Instead of saying, "This stock is going to break out," I said, "If this stock breaks above yesterday's high with double average volume, I will buy with a stop below the breakout candle." Instead of "the market feels toppy," I said, "If we get 3 consecutive closes below the 20-day moving average, I will reduce my position size." These if-then statements became the DNA of my new approach. They removed the ambiguity that had been killing my consistency. They gave me clear criteria for entry, clear criteria for exit, and clear criteria for position sizing. Most importantly, they worked regardless of how I felt about any individual trade. But having rules isn't enough if you can't follow them. And this is where the psychological component becomes critical, because your brain will fight you every step of the way. It will find reasons to break your rules, especially when those rules are telling you to do something that feels uncomfortable. I had to build systems that protected my rules from my psychology. This meant creating environmental controls that made it harder to deviate from my process. I removed the ability to manually override my stop losses. I set up position sizing calculators that prevented me from risking more than predetermined amounts. I created alerts that only fired when my specific criteria were met, eliminating the temptation to chase setups that almost qualified. The most important system was what I called my trading journal, though it was more like a psychological audit. After every trade, I recorded not just the financial outcome, but my emotional state before, during, and after the trade. I tracked my confidence level, my stress level, and any deviations from my predetermined plan. Within a few weeks, patterns emerged. I traded better in the morning than the afternoon. I made worse decisions after consecutive losses. I was more likely to break my rules when I felt like I was missing out on moves in other stocks. These insights became additional rules that governed when and how I traded. The transformation was gradual but undeniable. My results became more consistent. My drawdowns became smaller and shorter. Most importantly, I stopped experiencing the emotional volatility that had made trading feel like psychological warfare. But the real test came during my first major winning streak under the new system. This was dangerous territory because success can be just as destructive as failure if it leads to overconfidence. I'd seen this pattern before. A few good trades would make me feel invincible, leading to larger position sizes and looser risk management. But this time was different. My systems had rules for winning streaks too. After 3 consecutive profitable trades, I reduced my position size by 20%. After 5 consecutive winners, I took a mandatory day off. These rules felt counterintuitive when I was on a roll, but they protected me from the inevitable variance that follows every streak. The psychological shift was profound. I stopped celebrating individual wins and losses. They became just data points in a larger statistical sample. I started measuring my success not by daily profit and loss, but by how consistently I followed my process. A losing day where I executed perfectly felt better than a winning day where I broke my rules. This detachment wasn't emotional numbness, it was professional focus. Like a surgeon who doesn't get emotionally invested in each incision, I learned to execute my trading process without letting outcomes cloud my judgment about the quality of my decisions. The most surprising discovery was how boring successful trading actually became. The drama, the adrenaline rushes, the emotional highs and lows, all of that disappeared. What remained was a systematic approach that generated consistent results without the psychological cost I'd been paying for years. But systematic trading isn't passive trading. It requires constant monitoring and adjustment as market conditions evolve. What works in trending markets might fail in ranging markets. What succeeds during high volatility might struggle during quiet periods. The key is recognizing these shifts and adapting your approach accordingly. This is where many systematic traders fail. They build a system that works for a specific market environment, then stick with it religiously even when conditions change. They mistake consistency with their process for inflexibility in their approach. True edge requires both systematic execution and adaptive thinking. I learned to track not just my individual trade performance, but the performance of my approach across different market regimes. I identified which of my setups worked best in different volatility environments, which ones succeeded during trends versus ranges, and which ones depended on specific sector rotations or market cap preferences. This meta-analysis of my own performance became another edge. I could adjust my position sizing and strategy selection based on current systematic approach that had transformed market conditions without abandoning my results. I was still following rules, but the rules themselves evolved based on empirical evidence. The compound effect of these changes was remarkable, not just in terms of financial results, but in terms of my relationship with trading itself. It stopped being a source of stress and became a source of satisfaction. I was no longer fighting the market or fighting myself. I was simply executing a process that I'd proven worked over time. But perhaps the most important lesson was this: building real edge isn't about finding the perfect strategy. It's about becoming the type of person who can execute any reasonable strategy consistently. The market will always find ways to humble even the best systems. But if you can maintain your process discipline through both winning and losing periods, you develop the ultimate edge. The ability to adapt and persist regardless of short-term outcomes. In the final part, I'll walk you through the exact steps to implement this transformation in your own trading. You'll see the specific tools and frameworks I use to maintain systematic discipline, plus the warning signs that indicate when you're slipping back into emotional trading patterns. Because understanding the theory is one thing, implementing it consistently when real money is at risk is something else entirely. The hardest part about building systematic edge isn't the technical components. It's maintaining the discipline when everything inside you screams to deviate from the plan. Because your brain has millions of years of evolutionary programming working against you. It's wired for survival in an environment that no longer exists. And those ancient enemies, when you're trying to execute modern patterns, become your worst trading strategies. Let me show you exactly what this looks like in practice. You're following your system perfectly. 3 trades, all executed according to plan. 2 winners, 1 small loser. Everything feels controlled and professional. Then you see a stock making a massive move, something that would have been a 5-bagger if you'd caught it early. Your system didn't trigger on it because it didn't meet your criteria, but your brain starts playing games. Maybe I should expand my criteria slightly, it whispers. Maybe I'm being too rigid. Maybe I'm missing opportunities by following these rules so strictly. This is where most traders crack. They start making exceptions. They begin trading their emotions disguised as strategy adjustments. I had to build what I call interruption protocols, systems designed specifically to catch me in these moments of weakness and force me back to objectivity. The most powerful one was deceptively simple. Whenever I felt the urge to take a trade that didn't meet my exact criteria, I had to wait 60 minutes and write down 3 reasons why this trade was different from my usual setups. 90% of the time, by the end of that hour, the emotional urgency had passed. The other 10%, I had clear documentation of why I was considering a deviation, which helped me evaluate whether my criteria needed genuine refinement or if I was just being impulsive. But the real breakthrough came when I stopped trying to eliminate emotions entirely and started using them as information. Fear wasn't something to suppress, it was a signal that I might be taking too much risk. Excitement wasn't something to indulge, it was a warning that I might be getting overconfident. These emotional states became part of my systematic approach rather than obstacles to it. I created an emotional inventory that I checked before every trading session. On a scale of 1 to 10, how stressed was I? How confident? How impatient? If any score was above 7 or below 3, I either reduced my position sizes or took the day off entirely. This wasn't weakness, it was risk management at the psychological level. The transformation accelerated when I started viewing drawdowns differently. Instead of seeing them as failures, I began treating them as inevitable components of any systematic approach. Every back-tested strategy shows periods of underperformance. Every successful trader has experienced significant losing streaks. The question isn't whether you'll face drawdowns, it's whether you'll maintain your process discipline when they occur. I developed what I called drawdown protocols. If I lost more than 5% of my account from recent highs, I automatically reduced my position size by half. If the drawdown reached 10%, I stopped trading new positions until I'd reviewed my recent decisions for systematic errors. If it hit 15%, I took a 2-week break to reassess my entire approach. These protocols felt extreme when I first implemented them, but they served a crucial psychological function. They removed the emotional decision-making from the worst possible moments. When you're in the middle of a losing streak, your judgment is compromised by stress hormones and confirmation bias. Having predetermined responses protected my long-term edge from short-term emotional chaos. The most counterintuitive discovery was that my best trading periods often followed my worst ones. Not because of some mystical market karma, but because difficult periods forced me to tighten my process discipline. Losses have a way of clarifying what actually matters. They strip away the unnecessary complexity and focus your attention on the fundamentals that drive consistent results. During one particularly challenging month, I lost money on 14 consecutive trades. Not huge losses, my risk management kept each one small, but the psychological impact was brutal. Every morning felt like walking into a boxing ring where I knew I was going to get hit. But instead of abandoning my approach, I used the streak to audit every component of my system. I discovered that my entry timing had become sloppy. I was taking trades that met my criteria, but at suboptimal moments within the broader pattern. I was entering too early, before clear confirmation, or too late, after the best risk-reward had passed. The losing streak wasn't random bad luck. It was systematic execution drift. This insight led to one of my most important innovations, execution scoring. After each trade, I rated not just the financial outcome, but the quality of my execution on a scale of 1 to 5. 5 meant perfect timing, proper position sizing, and flawless risk management. 1 meant I took the trade impulsively with poor sizing or bad timing. Over time, I noticed a strong correlation between execution scores and profitability. Trades with execution scores of 4 or 5 were profitable 70% of the time. Trades with scores of 2 or below were profitable only 30% of the time. The market was rewarding quality execution and punishing sloppy implementation. This scoring system became another feedback loop that improved my consistency. It separated the quality of my decisions from the randomness of short-term outcomes. A perfectly executed trade that lost money got a high score. A profitable trade taken impulsively got a low score. This kept me focused on the process rather than getting distracted by results. But perhaps the most important element was building what I called systematic patience. This wasn't about waiting for perfect setups, those don't exist. It was about waiting for setups that met my specific criteria, regardless of how long that took or what opportunities I might be missing in the meantime. I started tracking my patience metrics, how many valid setups occurred each week versus how many trades I actually took. How often did I take marginal setups because I was bored or felt like I was missing action? How did my results compare between high patience weeks and low patience weeks? The data was clear. During weeks when I took only setups that fully met my criteria, my win rate was significantly higher and my average win size was larger. During weeks when I got impatient and started taking marginal setups, my performance deteriorated across every metric. Patience wasn't just a virtue, it was a quantifiable edge. This led to one of my most effective tools, opportunity cost analysis. Instead of focusing on trades I might be missing, I started calculating what those missed opportunities were actually costing me. Most of the moves I felt bad about missing were either impossible to predict in advance or would have required breaking my risk management rules to capture meaningfully. The few genuinely profitable opportunities I missed were vastly outnumbered by the marginal trades I avoided by staying disciplined. My systematic patience was protecting me from far more losses than it was costing me in missed gains. But this was only visible when I tracked the data objectively rather than relying on my emotional recollections. The compound effect of these systematic improvements was exponential rather than linear. Each component reinforced the others. Better execution led to better results. Better results led to more confidence in the system. More confidence led to better discipline during difficult periods. Better discipline during difficult periods led to faster recovery from drawdowns. Within 18 months, I'd transformed from someone who fought himself on every trade to someone who executed systematically regardless of market conditions or emotional states. The change wasn't just in my trading results, it was in my entire relationship with uncertainty and risk. I'd learned to thrive in environments where most people struggle to survive. But the most profound shift was philosophical. I stopped trying to beat the market and started trying to participate in it intelligently. I wasn't competing against price movements, I was partnering with statistical probabilities over time. This reframe eliminated the adversarial mindset that had been creating so much internal conflict. The market wasn't my enemy trying to take my money. It was a complex system that occasionally presented opportunities that matched my specific criteria. My job wasn't to force those opportunities to appear more often or be more profitable than they naturally were. My job was to recognize them when they occurred and execute my predetermined response with professional discipline. This systematic approach didn't eliminate losses, nothing can do that, but it eliminated the psychological damage that losses used to create. Each individual trade became less important because I was playing a longer game with better odds. I was trading like a casino rather than like a gambler, focused on mathematical expectation over time rather than the outcome of any single bet. The final piece of the puzzle was building systems that would continue working even when I wasn't actively monitoring them. Because systematic trading isn't about constant attention, it's about creating processes that function independently of your moment-to-moment emotional states or energy levels. I automated everything I could automate and systematized everything I couldn't. This wasn't about removing human judgment, it was about preserving it for the moments when it actually mattered. My scanning process became completely mechanical. Every morning at exactly 8:15, I'd run the same filters across the same universe of stocks. volume above average, price movement above specific thresholds, technical patterns that met predetermined criteria. The computer did the heavy lifting, narrowing 5,000 possibilities down to maybe 15 candidates that deserved human evaluation. But here's what separated this from typical screening. I tracked the performance of my filters themselves. Which criteria actually correlated with profitable outcomes? Which ones were just creating noise? I treated my scanning process like a trading system, constantly refining based on empirical results rather than theoretical appeal. The position sizing became algorithmic too. No more guessing about how much to risk, no more emotional adjustments based on how confident I felt. The formula was simple: account size times risk percentage divided by the distance to my stop loss. The math determined my position size, period. My feelings about the trade were irrelevant to the calculation. This mechanical approach eliminated one of my biggest sources of inconsistency. I used to risk more when I felt confident and less when I felt uncertain. But my feelings about individual setups had zero correlation with their actual probability of success. The systematic approach treated every qualified setup with identical risk parameters, regardless of my emotional state. The entry execution got systematized too. Instead of trying to time perfect moments within valid setups, I created entry protocols that removed discretion from the process. If a stock broke above resistance with confirmation, I bought within the first 5 minutes of the breakout, not when it felt right, not when momentum looked perfect, within 5 minutes, period. This eliminated the paralysis by analysis that used to plague my execution. I'd see a valid setup, then spend so much time trying to optimize my entry that I'd miss the move entirely. The systematic approach prioritized participation over perfection, understanding that getting in with good timing was better than never getting in at all. Risk management became completely non-negotiable. Stops were placed immediately upon entry before I could second-guess the levels. If a position moved against me, the exit was automatic. No hoping for reversals. No moving stops further away. No emotional negotiations with price action. The system executed its logic regardless of what I wanted to happen. The most powerful automation was in my exit strategy. I tested dozens of different approaches: trailing stops, time-based exits, technical level exits, percentage-based targets. What I discovered was that my optimal exit method varied by setup type and market condition. Breakout trades needed different management than pullback entries. Trending markets required different approaches than ranging markets. So I built multiple exit templates, each optimized for specific trade types and market environments. When I entered a position, the system automatically applied the appropriate exit strategy based on how the trade was classified. This eliminated the emotional decision-making that used to destroy my winners. I'd hold great trades too long, watching profits evaporate as I hoped for even bigger moves. Or I'd exit winners too early, afraid of giving back gains. The systematic approach removed these emotional pitfalls by defining exit criteria in advance and executing them mechanically. But automation alone wasn't enough. I needed feedback loops that would help me continuously improve the system without constantly tinkering with it. This balance between stability and adaptation became crucial for long-term success. I created monthly performance reviews that went far beyond simple profit and loss analysis. I examined my execution quality scores, my adherence to position sizing rules, my emotional state patterns, and the performance of different setup types across various market conditions. These reviews identified gradual drifts in my discipline before they became serious problems. The most valuable insight from these reviews was understanding my personal performance cycles. I traded better on certain days of the week, during specific hours, and in particular, emotional states. Instead of fighting these patterns, I incorporated them into my systematic approach. Fridays became position sizing reduction days because I consistently made worse decisions before weekends. I stopped taking new positions after 2 p.m. because my afternoon execution quality was measurably worse than my morning performance. I created mandatory break protocols for days when my emotional inventory scores indicated compromised judgment. These weren't arbitrary rules, they were data-driven adaptations based on my actual performance patterns. The system evolved to work with my natural rhythms rather than against them. The compound effect was remarkable. Each systematic component reinforced the others, creating an integrated approach that was greater than the sum of its parts. Better scanning led to higher quality setups. Mechanical position sizing prevented emotional risk management errors. Systematic exits captured more of each winning trade's potential while limiting the damage from losers. Most importantly, the approach was sustainable. I could execute it consistently whether I felt great or terrible, whether markets were trending or chopping, whether I just had my best week ever or my worst month in years. The system's performance didn't depend on my mood, my energy level, or my confidence in any particular trade. This sustainability became the foundation for genuine edge. Because edge isn't just about finding profitable setups, it's about executing them consistently over long periods of time. Many traders have good ideas that they can't implement reliably. The systematic approach solved that problem by removing implementation inconsistency from the equation. But building systematic consistency revealed a deeper challenge. As my execution improved and my results stabilized, I faced a new enemy: boredom. The emotional volatility that had made trading feel exciting was gone, replaced by methodical process execution that felt more like work than adventure. This transition challenged my identity as a trader. Was I still actively trading if most of my decisions were predetermined by systematic rules? Was I still using skill if algorithms handled most of the analytical work? These questions forced me to redefine what successful trading actually meant. The answer came through understanding the difference between complexity and sophistication. My old approach had been complex: multiple indicators, discretionary judgments, emotional reactions to every price movement. But complexity isn't sophistication. Often, it's the opposite. True sophistication meant building systems that were simple to execute but sophisticated in their development. The months I'd spent testing, refining, and systematizing had created an approach that looked deceptively easy from the outside but was built on thousands of hours of careful analysis and optimization. The boredom became a feature, not a bug. Exciting trading usually means emotional trading, and emotional trading usually means unprofitable trading. The systematic approach had eliminated the drama and stress that used to make every trading day feel like a psychological marathon. Instead of fighting this transition, I embraced it. Trading became my business rather than my identity. I showed up, executed my processes, and went home. Some days the market paid me well, some days it didn't, but my self-worth and emotional stability were no longer tied to those daily fluctuations. This detachment created space for genuine strategic thinking. Instead of constantly reacting to market movements, I could focus on longer-term pattern recognition and system improvement. I could see market cycles more clearly because I wasn't emotionally invested in any particular outcome. The most surprising benefit was how this systematic approach improved my discretionary judgment. By removing emotion from my execution, I could observe market behavior more objectively. I started noticing subtle patterns that had been invisible when I was emotionally invested in every price movement. These observations became the foundation for system refinements, not random changes based on recent results, but thoughtful improvements based on genuine insights about market behavior. The systematic approach provided the stable foundation that made this kind of evolution possible. After 2 years of systematic trading, I realized something profound had happened. I hadn't just changed my trading approach, I'd changed my entire relationship with uncertainty and risk. The skills I developed for managing trading psychology had applications far beyond the markets. Decision-making in other areas of life became more methodical and less emotional. I started applying systematic thinking to business decisions, investment choices, even personal relationships. The framework that had transformed my trading was actually a framework for thriving in any environment characterized by uncertainty and incomplete information. But perhaps the most important realization was this: systematic edge isn't about removing human judgment, it's about optimizing when and how you apply it. The system handled the routine decisions so my mental energy could focus on the genuinely important choices that required human insight. This division of labor between human creativity and systematic execution became the ultimate expression of trading maturity. I wasn't competing with algorithms or trying to outthink the market. I was partnering with systematic processes to implement strategies that neither pure human intuition nor pure algorithmic execution could achieve alone. The result was a trading approach that was both more profitable and more sustainable than anything I'd achieved through purely discretionary methods. But more importantly, it was an approach that could continue evolving and improving over time, rather than gradually degrading due to emotional interference or execution drift. In the final section, I'll show you exactly how to implement this systematic transformation in your own trading, including the specific tools, protocols, and frameworks that made the difference between theory and practice. Because understanding these concepts intellectually is one thing, building systems that actually work when real money is at risk requires a completely different level of commitment and precision. The implementation phase is where most traders fail. They understand the theory, they're inspired by the possibility, but they never build the actual infrastructure that makes systematic trading possible. It's like wanting to be a chef, but never setting up a kitchen. The desire is there, but the practical foundation is missing. Let me walk you through the exact blueprint I used to transform from emotional chaos to systematic consistency. This isn't theory, it's the step-by-step process that took me from bleeding money to building sustainable edge. Step 1 was creating what I call the trading constitution. Before you touch a single chart, you need to define your non-negotiable rules in writing, not suggestions, not guidelines. Constitutional law for your trading business. I spent an entire weekend writing mine, and it became the document I returned to whenever my emotions tried to override my logic. The Constitution covered everything: maximum daily loss before I stopped trading, maximum position size regardless of conviction level, required confirmation criteria before any entry, mandatory break periods after consecutive losses, exit criteria that couldn't be modified once a trade was live. These weren't aspirational goals, they were binding commitments I made to my future self. But here's the critical part most traders miss. Your constitution must be specific enough that a stranger could execute your strategy by following the written rules. Vague statements like trade with the trend or cut losses short are useless. You need precise definitions that eliminate interpretation. Instead of trade with the trend, I wrote only take long positions when price is above the 20-day moving average and the 20-day is above the 50-day. Instead of cut losses short, I specified exit all positions when price closes below the entry candle low or after a maximum hold time of 3 days, whichever comes first. This specificity was uncomfortable at first because it forced me to confront how much of my previous trading had been based on vague feelings rather than clear criteria. But that discomfort was exactly what needed to happen. Emotional trading thrives in ambiguity. Systematic trading requires precision. Step 2 was building the infrastructure that would enforce these rules automatically. I couldn't rely on willpower alone. I needed environmental controls that made rule breaking harder than rule following. This meant redesigning my entire trading setup to support systematic execution rather than emotional impulses. I started with my workspace, removed all the charts that didn't directly relate to my strategy, eliminated news feeds that created emotional reactions, set up my screens so the most important information was immediately visible while distracting data was hidden. The physical environment needed to reinforce systematic thinking rather than encouraging impulsive reactions. The software setup was equally important. I configured my platform to automatically calculate position sizes based on my risk parameters, set up alerts that only fired when my specific criteria were met, created templates that would automatically place stop losses at predetermined levels, removed the ability to manually override these systems without going through a deliberate multi-step process. This automation wasn't about removing human judgment, it was about preserving it for the decisions that actually mattered. The routine calculations and mechanical executions were handled by systems, freeing my mental energy for pattern recognition and strategic thinking. Step 3 was creating the feedback loops that would drive continuous improvement without constant tinkering. This balance between stability and evolution became crucial for long-term success. I needed systems that could adapt to changing market conditions without losing their core discipline. The daily review protocol became my most powerful tool for this. Every evening, I spent exactly 30 minutes analyzing making process. Did I follow my rules? Where did I deviate and why? What emotional states preceded my best and worst decisions? This wasn't about beating myself up for mistakes. It was about identifying patterns that could inform systematic improvements. I tracked metrics that went beyond profit and loss: execution quality scores for each trade, adherence percentages for different rule categories, emotional state ratings before, during, and after trading sessions. These metrics revealed patterns that pure financial results couldn't show. For example, I discovered that my execution quality dropped significantly after I'd been watching screens for more than 4 hours. This insight led to mandatory break protocols that actually improved my results despite reducing my total screen time. The data showed what my emotions couldn't see, that more wasn't always better. Step 4 was developing what I called market regime awareness. My systematic approach needed to be sophisticated enough to recognize when market conditions had shifted enough to require tactical adjustments. This wasn't about abandoning the system, it was about having systematic responses to systematic changes in market behavior. I created a simple dashboard that tracked key market characteristics daily: volatility levels compared to historical averages, correlation patterns between different asset classes, sector rotation indicators, breadth measurements. These weren't predictive tools, they were environmental assessments that helped me understand what kind of game was being played. When volatility spiked above certain thresholds, I automatically reduced my position sizes. When correlations increased dramatically, I limited the number of simultaneous positions. When breadth deteriorated, I shifted toward more defensive selection criteria. These adjustments were predetermined, not emotional reactions to market stress. The key insight, not just my trades, but my decision, was that edge isn't universal, it's contextual. What works in trending markets might fail in ranging markets. What succeeds during low volatility might struggle during high volatility periods. Systematic trading meant having systematic responses to these different environments. Step 5 was building psychological resilience protocols. Even the best systematic approach will face periods of underperformance, and your response to those periods determines whether you survive to benefit from future edge opportunities. I had to create systems that would maintain my discipline during the inevitable difficult periods. The drawdown protocols I mentioned earlier weren't punishments, they were protective mechanisms. When losses reached predetermined levels, the system automatically reduced my exposure and increased my review intensity. This wasn't about stopping trading permanently, it was about preventing emotional decision-making during periods when my judgment was most likely to be compromised. I also created what I called success protocols. Winning streaks can be just as dangerous as losing streaks if they lead to overconfidence and rule abandonment. When profits exceeded certain thresholds, I had systematic responses that prevented me from getting carried away by temporary success. These protocols felt counterintuitive when I first implemented them. Reducing size after wins seemed like missing opportunities. Taking breaks during losing streaks felt like giving up. But the data proved their value over time. They protected my long-term edge from short-term emotional volatility. Step 6 was the most challenging, learning to measure success differently. I had to retrain my brain to value process consistency over individual trade outcomes. This wasn't about positive thinking or mindset work. It was about building new neural pathways through deliberate practice and measurement. I created a process scorecard that I filled out after every trading session. Did I follow my scanning routine? Did I calculate position sizes correctly? Did I place stops at predetermined levels? Did I exit according to my rules? These process metrics became more important than profit and loss figures. Over time, I noticed a strong correlation between high process scores and long-term profitability. Sessions where I executed my system perfectly were profitable over time, regardless of short-term outcomes. Sessions where I broke my rules were unprofitable over time, even when individual trades worked out. This correlation reinforced the behavioral changes I was trying to make. Good process execution felt rewarding even when individual trades lost money. Poor process execution felt uncomfortable even when individual trades made money. My brain gradually learned to associate systematic behavior with positive outcomes. The compound effect of these 6 steps was transformational, not just in terms of trading results, but in terms of my entire relationship with uncertainty and decision-making. I'd learned to build systems that worked regardless of my emotional state, energy level, or confidence in any particular moment. But the most profound change was philosophical. I stopped trying to control outcomes and started focusing on controlling process. I couldn't determine whether any individual trade would be profitable, but I could determine whether my response to market conditions was systematic and disciplined. This shift from outcome control to process control eliminated most of the stress that had made trading feel like psychological warfare. I was no longer fighting against uncertainty. I was partnering with it through probabilistic thinking and systematic execution. The market became a laboratory where I could test hypotheses and refine systems rather than a battlefield where I had to prove my worth through daily combat. Trading transformed from an identity-threatening activity into a skill-building practice that improved over time. Within 12 months of implementing this systematic approach, I'd achieved something that had seemed impossible during my emotional trading years: consistency. Not perfect results, but consistent execution of a process that generated positive expectancy over time. The drawdowns still happened, but they didn't destroy my confidence or derail my discipline. The winning streaks still occurred, but they didn't inflate my ego or encourage rule breaking. I'd built systems that maintained their integrity regardless of short-term market behavior. Most importantly, the approach was scalable. As my account grew, the same systematic principles could handle larger positions and more complex portfolio management challenges. The foundation was solid enough to support whatever level of trading sophistication I wanted to develop. But perhaps the greatest victory was psychological. I'd conquered the internal enemy that had been sabotaging my success for years, not through willpower or positive thinking, but through systematic design that made emotional interference irrelevant to execution quality. The transformation wasn't complete overnight. It took months of deliberate practice to rewire my responses to market volatility and trade outcomes. But each day of systematic execution strengthened the new neural pathways while weakening the old emotional patterns. Now, 3 years later, I can honestly say that trading has become what I always hoped it would be: a systematic business that generates consistent returns without psychological drama. The approach continues to evolve and improve, but the foundation remains rock solid. If you're ready to make this transformation yourself, start with your constitution. Write down your non-negotiable rules in specific, measurable terms. Build the infrastructure that will enforce those rules automatically. Create the feedback loops that will drive systematic improvement over time. But remember, this isn't about perfection, it's about progress. Every emotional trader can become systematic with enough deliberate practice and systematic design. The question isn't whether you can do it. The question is whether you're willing to do the work required to make it happen. Because on the other side of that work lies something most traders never experience: true trading freedom. Freedom from emotional volatility, freedom from constant stress, freedom to execute your edge consistently regardless of market conditions or personal circumstances. That freedom is available to anyone willing to build systems that work better than willpower ever could. That freedom changed everything for me. 3 years ago, I was that trader staring at screens until my eyes burned, convinced that more analysis would somehow make me profitable. I was fighting myself on every trade, second-guessing every decision, bleeding money while telling myself I just needed to try harder. But here's what I discovered. You don't need to try harder. You need to try differently. You need to stop trading your emotions and start trading your edge. Real edge, mathematical edge, systematic edge that works regardless of how you feel on any given day. The framework I've shared isn't theory. It's the exact process that transformed me from an emotional wreck into someone who actually makes consistent money in the markets. The constitution that defines your rules, the infrastructure that enforces them, the feedback loops that drive improvement, the psychological protocols that protect your discipline. Every component builds on the others, creating something larger than the sum of its parts. A systematic approach that gets stronger over time instead of degrading under pressure. But knowledge without action is worthless. You can watch every trading video ever made, read every book, follow every guru. None of it matters if you don't implement, if you don't build the systems, if you don't do the boring, methodical work of becoming systematic. So here's what I want you to do right now. Not tomorrow, not next week, right now. Open a document and write down one rule. Just one. Make it specific enough that a stranger could follow it. Then commit to following that rule for your next 10 trades, regardless of how you feel about individual setups. That's how it starts, one rule, one commitment, one step toward trading your edge instead of your emotions. Because the market will be here tomorrow, and the next day, and the day after that. The question isn't whether opportunities will appear, they always do. The question is whether you'll be systematically prepared to capture them when they do. Your transformation starts with that first rule. Write it down, follow it, build on it. Because systematic traders aren't born, they're built. One rule, one trade, one decision at a time. The market is waiting, your edge is waiting. The only question left is whether you're ready to stop trading your emotions and start trading like a professional. Your future self will thank you for the choice you make right now.